Hello, I'm Ben Schrock, and welcome to another episode of Unlocking Your Financial Future. Today, I got some special guests with us, Gary Kowalski and Keith Abramo. Did I say that right, guys?
Nailed it.
We're good. So they're with Union Savings Bank, and we're going to talk today. We're either going to do it in one long episode, or we're going to mix it up into two different episodes and talk about what they do, how they can help people, especially like in our client base with retirees and with lending, and just kind of pick their brains about that kind of stuff. So, guys, welcome to the show.
Thanks for having us.
Thank you very much, Ben.
You bet. And for those of you who can't see us, so that are not watching on YouTube, we're sharing one mic. So this is the first go around. We're going to see how this goes, guys. You're our guinea pigs. But before we get into it, I'm going to, can you guys intro Union Savings Bank first? When you talk about banks, and we've had, individuals on our show before, when you think of banks, you think of, your Chases, your Huntingtons of the world. And Union Savings Bank isn't really like that household name, right? So can you give us a little bit background on Union Savings Bank, and then we'll dive into each of your backgrounds real quick.
Go ahead. Yeah, so the bank has been around primarily in the Southern Ohio area.
Okay.
For like an old school bank, about 100 years, give or take. The current ownership group has had it since the mid-'80s, and between Cincinnati, Columbus, Pittsburgh, Indianapolis, got about 40 to 50 branches.
Okay.
Been one of the top 5 lenders in Ohio for the last about 10 to 15 years without ever being in the Cleveland-Akron market.
Wow.
So end of 2021, they bought a building on Rockside Road in Independence, Ohio, about 30 minutes up the road from you guys. And the plan is to bring a handful of branches to Cleveland and expand into the market. So
nice.
We like to say, we do some common sense lending. When you're a little bit smaller of an institution, you don't have as much red tape.
Sure.
But we are essentially a lender disguised as a community bank.
Gotcha.
That's how we like to put it. So.
How's the transition up to this way going for you guys?
So far, really good. We've been having a lot of good outreach to the local community, and we've been getting a lot of good feedback. We noticed that the customers, the clients, they're enjoying actually working with us. They see the difference between how we work in contrast to the other local community banks that we're used to. And I think that one of the things that stands out is really our customer service. Most oftentimes when people think of going to their bank, they're having to physically go into the branch. And we actually make the effort to go to the individual, come to their either residence or their business to conduct and help them along in the context of the application and try to see what the best loan that we can fit them in. Gotcha.
And so can you guys give me a little bit of background on each of you? Have you always been in the lending industry? What kind of led you into that industry, and kind of how long you've been in there?
Yeah, so I'm going on this November. Will be 10 years in the wonderful, crazy mortgage industry. I was at the big dog. I was at Rocket Mortgage for about 9 years. I was a director of banking there on the purchase and refinance side of things, and came to Union Savings earlier this year as their market director for Cleveland. So I'm essentially bringing people in, bringing in the right people, working on the market share and all that kind of stuff for the hub that we're in right now, as well as the 5 or 6 branches, hopefully to come soon. So
awesome.
Done a lot, seen a lot.
Yeah.
But for the guys that have been doing this 20, 30 years, they've seen even more. So it's just one of those ever-changing industries.
The post-2008 world, it's a lot different.
A lot different world.
Yeah.
Together,
yep.
So.
Awesome. How about you, Gary?
So I started back in 2001 in the mortgage field. And
so he lived through the 08, so he's got the war stories from there.
Yes, and I worked for some big banks such as Bank of America, Dollar Bank, and I've worked for some larger mortgage companies that are actually still in business. We know that when 2008 and that whole scenario went down, so many lenders closed their doors.
Yeah.
So I learned a lot from many different, industries in the context of how different banks did business, and I saw how big lenders work with their customers versus smaller ones. And I think that's the good thing about Union Savings Bank is we kind of have the best of both of those.
Sure.
We kind of have that small town feel, but we have all that we need in the context of big banking and the technology that goes along with it to be able to get the customer through the system.
Yeah, nice. I like it.
Yeah, Gary's he lived through the mortgage crisis. He's actually only 30 years old. This is just working in mortgages for 30 years.
It does that, right? Oh, that's good. So let's kind of, I guess, We'll start with where things are today, I guess, right? I mean, with interest rates being so low for so long, you guys, I'm sure, were just swamped constantly. And have you seen a little bit of a slowdown now since the Fed's been raising rates all year, and mortgage rates obviously are going to be affected by that? Have you starting to see that brake pedal being pressed a little bit from the refinancing side of things?
Yeah, especially on the refinance side. I think on the purchase side, listen, the fact of the matter is, rates might not be in the 2s or low 3s anymore, but if you can still borrow money at 5-6% or whatever the case may be for 3 decades, that's a long time to borrow a lot of money. So it's still advantageous to a lot of people in the home buying market. The refinances have slowed down. The bank has done a very good job, though, of continuing to evolve, and without going into too much detail, for compliance reasons.
Sure.
Continue to involve pricing and the products that we can offer to where we can still find a way to help.
Yeah.
The folks looking to refinance, we'll go into a little bit of that later on. But, from a bank standpoint, decision-making standpoint, they've done a very good job of us still allowing us to have something to provide in terms of helping people.
Yeah, I mean, because the way that we always look at it with our client base, I should say our younger client base, pretty much anyone out there, when they go look for a house, they look for what can I afford on a monthly budget, right? Correct. So if I'm home shopping a year ago, right, I'm able to afford a $300,000 house on a certain monthly budget. Now all of a sudden I can only go and get a $200,000 house because interest rates gone up, and so then as a buyer you kind of get discouraged. It's already a tough market to buy in, and then this happens. So I was wondering if we've seen that from a home buying standpoint. People just kind of get fed up a little bit and say, "I'll just wait till things come back down." Maybe they won't. Maybe they won't come all the way back down. I don't know.
A little bit, and you had kind of a perfect storm because you had the rates go up, but you also had home values go up pretty healthily over the last couple of years. So you kind of had this perfect storm. So I think there have been a lot of people that have kind of put it on pause. I think once this new market becomes the norm a little bit more, and it's not as fresh, and everybody's fresh in everybody's mind, I think you'll get some of the a lot of those people that come back to the marketplace. But for right now, I think there's a lot of wait and see what happens in the next 6 to 12 months.
Because we've been spoiled for so long.
Everything is going against the grain right now as far as traditionally what happens with certain, political parties or certain reporting and stuff, and nothing is really just adding up to what history has shown us. So
definitely.
There's a lot of wait and see right now, that's for sure.
Yeah, and like I said, it's we've seen rates so low for so long. It's the little bit, like you said, anything in the 3-4 range, it's still a good rate. Let's be honest, but it's not the 2s that we're used to seeing. And now that's something too. Do you guys do like our adjustable rates and things like that? Is that where you're starting to lean? And again, if I ask you questions outside of compliance, let me know. But is that something? Because I see an opportunity there to say, okay, if rates they're elevated now and they're likely going to come back down a little bit, why not go to an ARM? Why not lean in that direction?
Yeah, absolutely. What we see is that most people, they're used to the 30-year loans, and they figure, well, their mother and father had them, sister and brother, and people that they know. But they don't realize that most people only hold on to their mortgage for about 5 years. And so either through a change of job or change in circumstances, they're either moving or doing something where they're taking cash out to maybe fund a college tuition or something like that. And so that's why ARMs are really, they're not the dirty word that they used to be. And so Union Savings Loan, the ARMs are extremely competitive. Oftentimes we're beating most of the other lenders in the context of that. And it's just a really good program for people to take advantage of because they're getting a really good low rate as when it was fixed. But obviously, they have a cut-off period. Normally the people take the 5-1 ARM.
Yeah. And that, can you guys real quick, I'll let you add in that part too, Keith, but real quick explain an ARM for those. Sometimes I assume everyone knows what an adjustable rate mortgage is. Can you explain what that means? And Gary mentioned a 5-1. I know there's 7-1, I believe 10-1s as well. So kind of explain that, and where do you feel the sweet spot is right now in terms of that ARM? And I love the point that you made too, Gary, about people moving or doing something every 5 years. I'm thinking about ourselves. We've done it now, I think 2 or 3 times, and it's all been within that 4 to 5 year time frame. So it's interesting you said that.
Yeah, and Gary had mentioned the ARM products today are almost completely different than what they were 15 years ago.
Sure.
When they kind of had that negative connotation. So for example, a 5-1 ARM that we offer. It's fixed for the first 5 years at the rate that's agreed upon. Right now, we're about 0.5%, almost a full percent lower than a lot of the banks up in the Cleveland Akron area. That's kind of done intentionally with us spanning into the market. We need something to blow everybody's socks off and
be aggressive.
And get them going. Exactly. When year 6 hits, the rate can adjust a maximum of 2 percentage points in that first year. Okay. And then there's also a lifetime cap on the rate as well. So it can't adjust more than 2 percentage points up or down. There were people that took out ARMs in the early 2010 range that ended up dropping. So what we do is we take a little bit of a step further. We go through what we call the doomsday scenario with the client, like, hey, if you sat in this mortgage for 12 years and never did anything, here's the highest payment you could ever see. So when the clients see the payment, because it reamortizes based off of the payment reamortizes based off the new balance every adjustment period. So as that balance gets lower and lower, that payment shock and that you're nervous about actually isn't, in most cases, as high as you think.
Is the capping of that, is that relatively new post-2008 world, or has that always kind of been baked in there?
That is newer now to protect against what happened, right? You had folks that their payment skyrocketed at $1,200 a month, month after month, and that was back when people were losing overtime and losing their jobs, and all of a sudden they couldn't. So now there's those checks and balances, so to speak, put in place, as well as what we do differently is we can do what's called a rate modification on these products. Where after that 5-year period, we can extend that rate. It might change a little bit, maybe a 1/4 point, maybe 0.5%, but we can extend that rate out another 1, 3, or 5 years. So you can essentially get 10 years without having to refinance and do a new appraisal.
It's almost like a mini refi inside of it, though, right? But no closing costs.
No cost. It's a free modification. So to the point that that Gary made, you're always selling, taking cash out, refinancing for some reason. Inside of 10 years, you're probably definitely doing that at least once or twice.
Right. So. Yeah, I like that little modification too, because it's something where if rates do go up and you did a 5-year and they're still kind of up, down, moving a little bit, and you're like, maybe I run this thing a little bit longer. That's a great way to do that.
Yeah, the ARM historically has always been about 0.5% to 1% lower than the fixed rate. Except for these last 3 or 4 years where you might as well just take the 30-year because it's it's lower than you'll probably ever see again. But
is that something that you guys do in your role? Maybe not so much on your end, Keith, but Gary, on your end with the consumer. So I have a client, right? I'm going to introduce you to them, and we know enough to be dangerous, I always say, in your guys' space, but not to the depths that you guys know. Is that something that you can help them with to say, okay, here's I would suggest this? Is that inside the scope of what you do, sitting down with the consumer?
Yeah, absolutely. What we can do is almost do a worksheet with them and help them understand comparison. If they did a fixed rate at the current rate it is today versus if they did an ARM rate and what their payments would be, and through the amortization of through the years on that, so that we can actually show what their savings would be, say, per month. And then we could also show them, say they want to build equity in their property quicker. That's the other thing, is that we can show them if they get the ARM and take their savings and apply that right to the principal, they're going to be so farther ahead at the end of that when they go to refinance, that say they're going to either sell the property or they're going to stay in a refinance, but they're going to have a lot more equity because of that.
Yeah, and I think that's where people oftentimes miss the boat. When they go to buy a home, I think they miss that guidance from people in your guys' shoes to say, okay, this is what that strategy alone is awesome that I've never heard when I've went to borrow money. I think that's huge.
And one of the benefits too was the type of loan officers that we're looking to bring in. There's a certain quality that I specifically look for and that we're looking for down in corporate in Cincinnati, and that's you got to be able to put yourself in the client's shoes. And when you I come from the largest lender in the nation, and when you get to be that big, sometimes you go too fast, and it's about
churn and burn, right?
Yeah, right. Not to say that there's bad client service, but there's just you can't take a breath and be like, okay, this is this client situation. What would I do?
Yeah.
And I think when you can take the extra time, break down the numbers. Some clients want just the meat and potatoes. Some want the ingredients, right? Some just want to get right to the point. What are the costs? What's the payment? Let's do it. Some want to know how this all works. And when you have the time and the care factor, I like to call it, to walk through each client, especially now everybody's situations are so different. It's all over the place.
Totally.
You know, in good and bad. So I think that's been a big help for us so far as well.
Yeah, you can almost put yourself in more of that consultative role and really be an advocate for the client, and as opposed to that. Because, I mean, ideally, right, especially if you're working those arms and things of that nature, you want a client to refi with you guys. You know, you want that business to be sticky and not go somewhere else. So, you know, doing it right on the front end is, you know, then they're going to likely come back to you.
Yeah, we don't do a whole lot of mass media marketing. It's really the word of mouth. That's how we get the majority of our business. And really, that's the type of business that we want. We want the people that really have had great experience with us to come with us and stay with us.
And you guys maintain most of the loans? You sell any of them off?
We do have, so we do have our portfolio product that we offer, which is typically the ARMs. And,
Yeah.
you know, they're extremely low cost. Right now we're advertising it, and this is not, there's no hidden fees with this. It's like $500 for a purchase. It's $250 for a refinance. I mean, it's
Like cost?
cost, yeah, plus escrow, but actual
Yeah.
cost, that's all. So I know people are going to listen to that and be like, there's got to be more to it. Call us, I promise. There's not. But,
Say that again one more time, Keith, so everyone can hear that. What's the cost?
So the costs that we're advertising now are $500 on a new home purchase.
Okay.
And $250 on a refinance. The disclaimer is obviously there's a certain clientele that fits into that bucket.
Sure.
But we service those loans in our portfolio loans, and we are our bank culture comes from the owners themselves. Once you're a client of ours, we don't ever want to lose you.
Right.
So the servicing is second to none and top notch, and it's a priority with the bank. Where some other banks kind of sit on it like a almost like an investment, where if they need to sell it off one day, they can. We proactively kind of monitor what's going on with our current clients versus the market.
Sure.
And if there's an opportunity for them to get in a better spot, we'll proactively reach out to them in a lot of cases.
Yeah, I like it. And so as we're talking here, I think what I'm going to do is a couple more questions, more on the personal side, and then we'll talk a little bit more. We'll cut it into the second episode, talk more about your different lending options with maybe your more investors, retail investor or real estate investors, and things like that. So, but like on the I guess on the average everyday home buyer, builder, whoever it may be. Do you guys do construction loans too?
Yes.
We do, yep.
So you pretty much do everything a big bank does, just on a smaller scale. And I love working with small banks because you do have a little bit more. I don't want to say leverage. You just kind of they care about you. They'll look at your situation as a small business owner myself. They look a lot. You go to the big banks, they look at you and say, well, that's not too risky, right? Too risky of a client for us. So thanks, but no thanks. So with smaller banks, they actually kind of hear you out and actually will dig in and look at the underwriters will actually look a little bit deeper and look at the full story.
Correct.
So when it comes to like the home buyer, home builder, where do you guys see right now debt to income ratios? Where are you guys pushing that from a lender standpoint? Is it the top end? Is it 40, 50, 49?
We typically you want to be under 50.
Under 50?
Under 50. Under 45 is great, but under 50 is that threshold on a conventional loan. We do offer FHA loan products as well, which is kind of geared more towards the first-time home buyer.
Yeah.
Right now, which we can go up to, again, everything else falls into place. We can go up to actually 57%
Wow.
debt to income ratio. And VA loans, you can, if you're a military veteran, you can technically get qualified up to 60%.
Jeez.
It's a conversation to have with the client, though. Hey,
Right.
this is what you qualify for on paper, but here's the payment.
Maybe not advisable.
So like and again, that's where you kind of take a step back. Like, hey,
Yeah.
we could do this.
Right.
But are you comfortable with
Can
this?
you
So that's-
really do this? Yeah.
Correct. 'Cause that, got to keep in mind, those debt ratios are based off what's on your credit. It doesn't take into account utilities, groceries,
Right.
Everyday expenses. So it's always important to take that extra couple minutes and talk that over with your client as well.
When it comes to that side of things too, do you guys also help with that debt? I guess more consult from that perspective. Say, hey, how do I clean up some of this bad debt that I got? Or, hey, you got this, credit card or something reporting in there. Credit cards, I think, don't they just report the minimum? I think
The minimums, yeah.
So like maybe some student loan debts or something like that, to where you can wipe off some of that big chunk and maybe
Right now,
approve
we'll
for
have
more.
them give some guidance. We're not credit experts,
Yeah.
so we don't want to go too deep into it because credit works so goofy nowadays with
Yeah.
how the scores update and stuff. But we'll give some general guidance, and we do have a few team members that kind of specialize on the credit side that we'll send them to get a little bit more in depth of a look into it and a diagnosis, for lack of a better term.
Sure. Anything else on the consumer side? I guess we stayed in that lane. Anything else there that you guys want to add in terms of your lending options for your everyday consumer? Because like I said, I want to kind of split off to this. I know I got some of these flyers here that I really want to dive in deeper on how you guys do with the blanket loans and things like that, and spend some time getting into the weeds there. But anything else you want to add from a consumer lending from your like first time home buyer, or just retiree buying a house?
Yeah, I think my only 2 cents would be give us a call. No, but but no, I mean, this is what we've chose to do for a living, and careers, and we have a very dialed in team that takes their time. We move fast, but we go slow, if that makes sense.
Yep.
So if you do have any questions, we offer a ton of products to help. Maybe, if you've been told no elsewhere, definitely give us a call, because we can get pretty creative with how we can get you qualified. So
awesome.
We also like to help out first responders.
Okay.
So we do a lot for those as well.
Great. And how do people reach you guys? So give yourself the plug, your phone numbers, address, emails, website, all that good stuff.
My phone number is 440-533-8451. That's the best way to reach us.
Okay.
And from there, my email is gkubalski@usavingsbank.com.
Perfect. And if anyone else needs help, I can always connect you.
Absolutely.
So,
Absolutely. Thank you.
You bet. So, okay, we're going to wrap up episode 1. Just to recap, we talked more on the personal lending side. I guess that was the direction we stayed in. We'll kind of unlock some of the different options that Union Savings Bank has to offer here on part 2. So, Gary, Keith, thanks, guys, for coming on part 1. We'll be right back for part 2.
appreciate it. Thanks, Ben.
Yep.
Thank you.